Hello there. You're listening to Paradigm Shift, a podcast about people building the future and pivotal moments in their journey. I'm Ashish, and I'm joined by my co-host Zane. And today we're thrilled to speak with Jim Brusstar about his startup journey and co-founding Treasury Prime. Treasury Prime, which announced a 20 million Series B earlier this year, offers a banking-as-a-service API, which companies like Brex and Lending Club use to embed core banking features into their products. Thank you, Jim, for being here.
Glad to be here.
I noticed that you started your career at Facebook quite early, 2010. Did you know back then that you wanted to eventually start a company?
It's only in retrospect that that seems super early. When I started at Facebook, I think the company was about, 700 or 800 people, which compared to the other companies I'd worked at, I did an internship in college at Microsoft. It seemed pretty small and startup-y, but from where I sit today, it seems huge, right? 700 or 800 people. Treasury Prime, by contrast, is about 45 as of today. So 700 just still seems like a big company from our perspective. But yeah, Facebook was great. I mean, I always sort of had in the back of my mind that startups were interesting and that might be something I wanted to do. I didn't really feel compelled to found one necessarily, but I always sort of thought if the right opportunity came along, if the right idea came along, that I would. It was a tool in the toolbox.
Yeah, I love that. I think that sounds like the right way to do this, right? Like, doing a startup is like a means to an end. Like, there's a problem you want to solve or something you're passionate about. And it sounds like that was your approach. You were drawn to problems and teams, and eventually that led you to a startup. So along the way, I know you were in a number of really interesting startups. So you did Facebook for a while, and then you spent some time at Sidecar, and then Standard Treasury, which was banking as an API product, which to some extent, I think, led to what you're doing now. So tell us about those early formative experiences. Maybe we can start with Sidecar.
Yeah, Sidecar was a cool company. I only worked there for a year. I joined because some of my good friends from college, from the University of Michigan, were the founders and early employees there. And I'd sort of seen from afar that they were really starting to get a lot of traction, and they encouraged me to join. So I did. And Sidecar, yeah, really interesting company. I mean, the growth was there. A lot of people don't remember it now, but there was a time when Sidecar effectively invented ride sharing. Back then, Uber was still doing black cars. Lyft didn't exist yet. It was really only through pivoting and copying Sidecar that Uber and Lyft were able to grow to be, as big as and important as they are today. The shame of Sidecar is that obviously we got out executed. But I think that, for the set of users who remember it and used it, Sidecar, it worked great and it was a cool service. And I think, we all learned a lot.
I didn't know that was the case, that Sidecar first invented ride sharing. The history as it's been written by the winners is that Lyft invented it. So tell us about that. What was that early sort of process? How quickly did they copy it and what happened?
Yeah, it's a good question. You're right about history is definitely written by the victors here. And invented ride sharing, I mean, that's obviously kind of a squishy term. I mean, obviously there were companies prior to Sidecar that were doing things like ride sharing. But even the idea of using essentially your phone to find drivers going in the same direction. I mean, I think the CEO of Sidecar, Sunil Paul, he had been working on that as far back as, 2000 on feature phones. And Sidecar actually had patents to that effect that Sunil had gotten. It was like you say, right? It was a time when a lot of people were thinking about stuff like that and trying to figure out what was the right model. And Uber had already gotten pretty big, but they had done this on the TCP black car, limo model, which is the TCP drivers in California. That's a state licensed limo driver. And that was one way that they could skirt essentially local taxi regulations. That worked okay, but you had to pay these guys enough money to make it worth their while. They were driving town cars, which use a lot of gas and have a lot of maintenance. And so I don't know if you were in San Francisco in 2010 and using Uber, it wasn't super cheap. I mean, taxis weren't cheap either because it was a sort of captured market, but Uber wasn't super cheap. And Sidecar's innovation was to come along and say, what if you don't use a limo license or a taxi license? You just let people drive their own cars. And there was a piece of legislation in California that sort of made that gray area legal. And, you could really change the cost structure substantially if you did it that way. And, Sidecar got a lot of traction in San Francisco with that model. It's funny now because we take it so for granted, but the hardest thing about growing Sidecar, I think back in, 2011 or 2012, whatever year it was the idea of just getting into a stranger's car. It was so foreign to people, right? Which we just all sort of do that now. But back then, that was always the biggest thing we'd need to explain to people is no, it's okay. These are normal people. They're vetted. They do a good job. And the bad actors, we kick them off pretty quick. I think the tricky thing about Sidecar was just that it was all of us, Sidecar, Lyft, Uber, we were all operating in this sort of like legal gray area. And, we all had arguments about who was more or less legal, but it made for sort of like an interesting time to trade off product features versus what at least we perceived to be possible under the law. So Lyft originally, remember, that company started as Zimride, which was a more corporate oriented, like, hey, let's van pool to work kind of thing. I think they'd been working on that company for 5 years or something. And after Sidecar started gaining some traction in, I think, 2011, they actually pivoted the company, raised more money, and then started competing with Sidecar directly. And if you went and looked at the first version of the Lyft app, I mean, it was almost pixel per pixel the same as Sidecar's app, right? So yeah, I mean, it was like there was some intense competition back then.
Jim, I mentioned earlier that I was an early adopter of Sidecar, and I just searched my email to find like when I started using it. And I emailed them in March 4th, 2012. And I'm looking at my email to support, and it was, I took this ride last night. It was amazing. I don't think I paid the driver. Can you make sure I paid them? And I think it was because it didn't sink into my brain that I pay through the app. Like, it was so new, right? Because I used to take cabs to the airport. It would cost like $60 and I have to like go out on the curb at 3 a.m. And with Sidecar, I just called it. It showed up. I didn't have to wait. Payment was through the app. I do remember there was an adjustment period. I remember I got to the car and I was like, where do I sit? Do I sit in the front or the back? Like, what's going on here? And there was like a conversation with the driver about it. But It was, to your point, it was like a magical experience.
Jim, if you could go back in time, hypothetically, what's one thing you might do differently that you think might have had an impact on Sidecar's eventual outcome?
I think what we've seen, like, 10 years later is Lyft and Uber. I mean, these continue to be tricky businesses, right? Because they ended up being a lot more capital intensive than people thought originally. Yeah, I don't know. I think that maybe there's some strategic decisions that, we might have made differently, like knowing that that's what the future held. Probably true of Uber and Lyft too. I think there are probably also some product changes that we would have done differently had we known. So, I mean, if you go back to, I think it was 2012, Thanksgiving of 2012 is when the California PUC slapped Sidecar, Uber, and Lyft, all of us, with a cease and desist, and basically said, hey, you guys are violating transportation laws, basically. And, every day you continue operating, we're going to fine you. I don't remember what it was, some thousands of dollars. And effectively, the state decided that they didn't want us around, and the industry as a whole, all of us got together. And because our users love the product so much, collectively, I think that California was able to change its mind and then kind of retroactively legalized all of these services, right? Before that, we had all sorts of arguments about like, hey, do you need to pre-specify a destination in the app, right? Some apps did, some apps didn't. Do you need to show the users picture to the driver? Do you need, right? There are all these questions about like what exactly would be inside or outside the requirements of the law. And I think if we had known that, we would have just gotten through it, and then the state would have basically just said, cool, here's a new type of transportation network company is what they ended up calling it. Here's a new regulatory category. We're post facto, we're going to make all this stuff legal. We might have been a little more aggressive in some of the product features just to make the experience as good as possible. But, it was tough at the time because we were trying to really walk that line and make sure that we were on the right side of the law.
So Jim, after Sidecar, you ended up at Standard Treasury for a few years, which was a fairly early fintech company building a banking API. What's the story behind that? How did you end up there?
It's amazing how you've had this knack for being early on these like massive tidal waves. It's really incredible. Do 2 in a row, because banking APIs was sort of like, like just starting out back then. So yeah, how did you end up working on that?
That's nice of you to say, Zane, although I'll say like it was so early as to be, too early, right? I mean, that was 8 years ago. That's a lot of early. After I left Sidecar, I was thinking the same thing I thought when I left Facebook, which is like, what are big areas of the economy that the internet has not touched yet? Right? Because these are areas that are essentially like ripe for improvement. And there'd probably be a lot of opportunity there. And, transportation, I mean, that's what drew me to Sidecar in a lot of ways. It's like transportation. So many people have this very expensive asset just collecting dust in their driveway, right? And it's their car. And if you can figure out how to utilize that asset much more, there's a lot of value to unlock. And I think that similarly in banking, I think this is still true, by the way, in countries like the United States, huge portion of our GDP is related to banking and finance. But when you dig under the covers of like banks, they're not organizations that are built around the internet, right? Literally speaking, their software is like mainframe software, usually that was written 30, 40 years ago, right? There aren't many good vendors offering alternatives. And they're sort of like workforce service model, whatever is like built around that sort of pre-internet world. And so it seems like there's a lot of inefficiency there. And it's really the products that come out of that are not oriented around like how you might build them, given that the internet exists, given all the technology we have today. So like, I think there's a lot of opportunity to like optimize that market. That's kind of what drew me to it. Standard Treasury was a YC company from 2013. I think it was the winter 13 batch. And the founders there were Dan Kimmerling and Zach Townsend. And I ended up meeting them through a mutual friend right around the time that they were finishing up the YC batch. I think it was like right around demo days when I met them. And I remember we had dinner in some hotel restaurant, like in the Tenderloin in San Francisco. And, they kind of sold me on the vision. And, I had already been thinking about banking and they seemed pretty credible. And so I ended up joining them as, I'll claim like first engineer, although I'll say that it was probably either me or Mike Clark. I don't know. I think one of us maybe signed our offer first. The other one started first. I'll claim it's me. But we had a good little group there. And so we worked on that company for a couple of years, basically from the time Dan and Zach finished YC. They raised some money. We worked on that for about 2 years and ended up selling it to Silicon Valley Bank, who had been our first customer. And like to your point, Ashish, like we were so early, Standard Treasury, that was a DBA. The actual corporate name of that company was Financial Tech Inc. Right? Like fintech was so new, the name of the company was fintech. Like it's kind of silly, right? But yeah, I mean, broadly, like we were trying to do, I think, we were trying to do basically the same mission that we're trying to do here at Treasury Prime. But, it was early enough that the banks weren't ready to hear about it. And the demand side, the sort of set of fintechs who would want to use a service like that didn't exist yet, right? Because the market was too young. And so, that just means we were too early. So we ended up selling it to Silicon Valley Bank and kind of becoming their in-house team.
Give us a brief overview of what Standard Treasury was trying to do, because not everybody would probably knows.
Yeah, for sure. So let's say you want to go build an app. And, you want to do financial operations in your app. Now, maybe that means you're, what we would today call a neobank. Basically, you want to be a white labeled bank that does everything a bank can do, take deposits, issue cards, make payments, maybe even write loans. Or maybe, you want to do something that's more targeted, something that today we might call like embedded finance, where you're taking features of a bank and putting them into a more non-bank oriented product. If you wanted to do those things, what are all the steps that you need to do to make that happen? Well, it turns out in the United States, we have these special corporations called banks, and they have superpowers that regular corporations don't. Namely, they can hold deposits, and they have some privileged access to certain payments infrastructure. And so if you want to, as a developer, if you want to build one of these financial apps, you need to find a bank to partner with. And, this seems more straightforward now in 2021, but like back in 2013, that was a really opaque thing to do. And there were only really a handful of banks who were even considering working in that space. And so, this was a very arduous process to find one of these banks, go fly to wherever their HQ is, meet with them, hammer out some economic agreement where like they'll give you some degree of access to their services and let you basically resell them. Do all of that. And then you've got to integrate with their systems, which are like super old legacy systems. This was like a super hard problem back then. And what we felt at Standard Treasury was that there needed to be some kind of infrastructure layer like a Twilio, right? That made it just like orders of magnitude easier to integrate into that market. And that if we could do that, that would unlock just like the next level of innovation in sort of like what we would now call fintech, right? As a data point, I know if you guys remember that company Simple, which was like one of the first neobanks. Simple was great. I mean, that was like super inspiring, I think, to everybody who's into fintech, then and now. And we're lucky enough to be friends with Shamir, who was the CEO there. And like, I think he said, like, I think it took them 3 years to go from like starting to build Simple to launch, right? 3 years. And why? It's because of everything that we just said, right? It's dealing with the banks, doing those integrations. It was just really hard back then. And, if you're a startup, 3 years is a long time to get an actual user, right? I mean, that'll kill most companies. So, I mean, it was a real problem. It's still a real problem, but, luckily, Treasury Prime, through our work and through some of our competitors too. I mean, it's just the market is so different now. We can get, when developers today come to us and they want to get started, it's a matter of like weeks or days and not years. And so it's been a huge improvement. But that was sort of the insight back then. It was like somebody needs to build this infrastructure layer to unlock this market.
So you guys took a run at this at Standard Treasury, ultimately sold to your main customer, which is Silicon Valley Bank. So now you're at the customer, right? So you worked for Silicon Valley Bank for a while as like one of their, most senior engineers, and you sort of see this industry from the other side of the fence. So what did you learn? And then how did that lead to basically like taking another run at the same problem? And also tell us how you think about banking. How does banking work? How should like a normal person think about this? It seems like such a complicated space. I think you've sort of understood it and seen it from different angles. So how do you think about it?
It's funny when you work inside the bank, you can see that it's a lot different than what it might seem from the outside as a developer, even fintech. And we see this a lot. Honestly, even now, customers come to us. We have fintech founders who have really cool products that they're trying to build. They have customers, they're having success, they're having traction. They really don't know how banks work under the covers. What are the actual incentives? How does the bank make money? What does the bank care about? What does the bank not care about? A lot of misconceptions. And yeah, I mean, when you work inside the bank, some of those misconceptions get dispelled. So like, okay, the main thing I think that people don't understand is this, right? Let's say I'm gonna start a regular business selling corn, right? Like I'm gonna buy corn seeds, I'm gonna grow the corn, I'm gonna sell corn, right? So it's like corn seeds in, corn out, right? And then like the price I'm getting on the corn minus the price I'm paying for the seeds, that's like my margin, right? Cool. That's a regular business. Well, banks aren't magic. They're no different. It's just that instead of buying and selling like corn or something, they're buying and selling money. They're buying money in the form of deposits, right? They pay you, well, today, not very much, but let's say, 1% to hold your deposits. And then they're going to sell money in the form of loans, which let's say, mortgage, 4%, something like that, right? 4% minus 1%, 3%. There's a margin. That's how the bank makes money. So the bank, it's like any other business. It's just that they're buying and selling dollars instead of whatever good. And that's the key thing. So because of that, what are banks oriented around? Well, like any business, they're oriented around like, where are they making their revenue and like, how are they holding down their costs? And most banks make the majority of their revenue on loans. And so mostly that's where banks' attention goes, is loans. And the people who generally like get promoted and run these banks, they're people who are lenders and they understand that, they're good at that. Oftentimes they're salesmen, and banks have a lot of attention there. Where banks don't have as much attention are places like software. Why is that? That's not their business, right? They're not software companies. They're not selling software. They're selling loans. And so generally what banks do, with the exception of a few very large banks at the top, generally they're buying off-the-shelf software from a few vendors. And that's how they run their business, which again, not that different than any other business. The problem for most banks is that the vendors who are selling that software, there's not very many of them. It's sort of an oligopoly. In the United States, that's FIS, Fiserv, and Jack Henry. These are companies who sell core banking services and other supporting pieces of software. And I think in the core market, they control, 95% or something like that. Don't quote me on that, but it's a very large number, right? So you don't have a lot of choice in this market. And frankly, a lot of the software they sell is super old. It was first developed decades ago, usually runs on mainframes. Luckily, the banks don't actually have to physically run the mainframe hardware anymore. I think it's like, in a data center somewhere. But really, at the end of the day, it all boils down to mainframe stuff. And so it still really constrains what banks are able to do. When you're a startup or any company that wants to work with banks, it's like you have to understand this incentive structure to make sure that you have a strong partnership. And then the other thing in the background of all of this is like banks are heavily regulated, right? For good reasons, but good banks, bankers are always thinking about that in the back of their mind. How can they stay compliant? How can they make sure that, they're going to maximize their business, but they don't want to run afoul of the regulators, because there are plenty of examples of banks that kind of played it too fast and loose. And, we're really sad about it later, and nobody wants to deal with that. So in a way that's similar to Sidecar, right? It's that when you're operating in a market where you really have to understand the incentives, not just of the market, but also the regulators and sort of the underlying laws and the kind of market dynamics that come out of that, which makes it tricky, frankly.
That seems like something that would make it hard for a startup to get traction too, right? Because small team, there's a question of, will you be around a long time? Can I trust your security? How do you guys navigate those types of questions? Today, I think startups are a lot more widely sort of like understood and respected, but that wasn't always true. And it probably wasn't true when you started the company. So how have you approached that?
It's definitely true. And this is something that I think startups who work in regulated industries, and banking being one of them, We all face this, and it's sort of a cost of doing business. You have to deal with it out of the gate. I mean, from day one, we were working on getting our SOC certification and all the sort of compliance certifications that we need to maintain to, access things, to deal with like PCI or deal with credit bureau data. There's just a lot of hoops you have to jump through. It really helps if you know that you're going to have to deal with that from day one, because you can build your systems in a way that isn't going to cause you a problem later on, right? It's always harder if you have to re-engineer down the road. And having done this before, we knew out of the gate that that was going to be a prerequisite really before we got even our first customer. We've spent a ton of time on that, and it's sort of a cost of doing business. Part of our hope here is like, that's something that by providing the infrastructure, we, Treasury Prime, can sort of do a lot of the lifting on that ourselves and hopefully make it easier then for our fintech or developer customers downstream of us to not have to do as much, right? We can make it a much more safer kind of environment to operate in. And that helps the banks too, right? Because then they feel like they can have a higher degree of trust in their fintechs too, that they're partnering with, because we can sort of provide guardrails, whether it's compliance or risk or what have you. So we do a lot of that. We have from the first day, just because it ends up being sort of a prerequisite just to be in the industry.
Going back to the business model, which I think is like such a clear and crisp way to articulate it, which is like banks are in the business of buying deposits and selling loans. So you've been on the inside of this, and you've probably seen how these banks operate, and like most of the money is made on the lending side. If we were to look at one of these balance sheets, clearly like banks hold a lot of capital and they have multiple revenue streams today. What proportion of the revenue comes from lending versus like, let's say, interchange or other ancillary kind of services?
It's a good question. It depends on the bank. I don't know the industry stats right now. I think that some of this too has changed a little bit in the pandemic. I mean, certainly like with all the stimulus, the amount of deposits has gone up substantially. I think we're at like about $20 trillion in total deposits in the US now, something like that. It used to be before the pandemic and before all the stimulus, most of the banks we talked to were actively looking for new deposit sources. I think that's less true at the moment, but to some extent, these things are kind of cyclical and like just related to market conditions. The thing that's going on right now, of course, is just that interest rates are super low. So it's like, your savings account's paying 10 basis points or something, which again, like sort of changes some of the incentives. But yeah, I mean, most banks are going to get, most of their revenue from loans, but it's not every bank. There are banks who are sort of, I would call them like specialists, and, banks, in the sort of bank taxonomy, there's sort of interest income, which is like related to lending. And then there's what they would call non-interest income, which is their more fee-oriented income. And like, there are banks who are, let's say like, card program specialists where, the majority of the revenue is coming from non-interest income because it's, I don't know, card interchange, card fees, stuff like that. They're not in the majority. The cool thing about banks though is that they are like, because they're so regulated and most of them are publicly traded, it's super easy to just, you can jump into Google and look up their balance sheet for almost any bank. So yeah, definitely. It's like, there are stats out there. So definitely for people who are interested, they should just pop it in.
Tell us a little bit about Treasury Prime. So you're at Silicon Valley Bank. You decided to take another run at this. Walk us through the product and how you work with banks and some of the cool things it enables.
The thing that we recognize working at Silicon Valley Bank is that we knew that our goal from Standard Treasury was not solved yet. And we really wanted to like figure out a way to make it so that developers easily could embed financial products in their apps. And, we looked around the market and like, it still felt very unsolved. I think that the thing that's really unique about the approach we took is we think that banks are valuable, and that to have a durable fintech partnership, the bank needs to be invested in that partnership. Why is that? I mean, there are plenty of examples, I think, if you go back in fintech, of partnerships that just fell apart because the bank lost interest, or the bank felt that, they weren't getting enough value, or maybe some hiccup happened and the bank got spooked about the fintech's riskiness, fairly or not. And the trouble for the fintech is if that happens, that can be the end of your business, right? Because doing these partnerships can be such a heavy lift. To go back to the simple example, that took 3 years. It can be such a heavy lift, and migrating your users can be such a pain in the butt that if something happens and the bank decides they don't want to work with you anymore, and that it's not a good fit, then that can be a real problem for your business. And so we really felt that was a key problem here. And frankly, for scaling, the United States has like something like 4,500 banks. And if you're going to try and convince me that like one of the 4,500 banks can house every future fintech, I just don't believe you. That's kind of like, to me, that's kind of like saying, hey, let's fly every flight through Denver airport. I mean, Denver's a nice airport. They can accommodate a lot of planes, but like there are a lot of other airports, right? And if you really want to scale up air travel to like everyone, you got to support more than one airport. And so we really wanted to build an approach from the first day where we could build a network of banks and really figure out a way that we could scale this so that any bank who wanted to work in this market and who wanted to work with fintechs and really use this as a source to grow could do it, and could do it safely and quickly and affordably. And that on the flip side, for fintechs who wanted to build in this market, they would be able to find the right bank that's a fit for them. And so that it would be a strong two-way partnership. And so, that has sort of like elements of a marketplace. I don't think it technically is a marketplace, but in our mind, it was really important to get that dynamic and get those incentives right, where both sides of this are really committed to it. And so that's kind of like what's unique about us.
It does sound kind of like a two-sided API brokered marketplace, where on one side you've got like a growing base of banks who you can plug into through your API, and on the other side you've got a bunch of fintechs. Like your customers include like Brex and a number of companies. So how does that work? So if I'm Brex, or if I'm like a new startup that wants to build an embedded finance application, how do I get matched with the right bank? And what is some of the flexibility as a result of there being multiple vendors on the other side?
First step is you'd get in touch with our team. And what they would do is they would ask you about your business and, what are you building? What are the features that are important to you? What are the features that are not important to you? What's your roadmap? What are you going to need a year from now? How are you going to scale up? All of that matters because it affects what bank might be a good match for you. Once we know that, we basically go to our network of banks and we figure out what are the banks who are interested in working with you. And honestly, banks from the outside, it's easy for us to think of them as commodity because, as a consumer, it sort of feels commodity in a lot of ways. And a lot of banks are, especially commercial banks. That's just not true. And all of them have preferences and have ideas about how they want to structure their portfolio and structure their business. Every bank has preferences around different industries that they want more exposure to or less exposure to, services that they're going to be more or less capable of providing operationally, and different amounts of expertise, different risk tolerances. A really kind of like easy example is crypto. Like, let's say you were saying, hey, I'm going to start this fintech company, and a big, component of it is transacting in Bitcoin. Well, a lot of banks don't work with Bitcoin because it's a huge compliance burden for them, right? So immediately that would sort of select a subset of the banks on our network. Say, well, okay, these two or these three are interested in serving crypto customers. They want to do that. These ones don't. So, we're going to put you over here. And, there are other categories like that too. That's just sort of a particularly easy one. But that's what we would do. And then effectively, our team would match you with that bank. There would be some conversation between you. And then ultimately, if there's more than one bank who's a good fit, you'd get to select between them. The key thing for us is we want to make sure, again, that just like it's a good partnership for both sides. The bank wants you, the fintech, and the fintech wants the bank. We think that's key to having a long-term success.
What's the number of banks you've got that are sort of like plugged into your APIs today, or a rough number, whatever you can share?
Yeah, the number we quote right now is 6, but it grows all the time. We'll probably have more announcements about that soon.
That's really cool. So if I want to build a fintech app, I come to you, you match me with the right bank, and you've got sort of this network of banks with different priorities. Maybe one wants more deposits, one wants more of a certain kind of user because they prefer lending to that user base as a credit union. And you mentioned there's like 4,500 banks and with no tech. So you're kind of like their API. And that's like incredible. Like, it's such a brilliant insight. I guess one question that comes out of that is, how do you think about the economics and the incentives? So like, what's sort of like the rev share between these parties? And how do you think about if I'm Brex or if I'm like a customer that gets really big, and why wouldn't I just sort of like at some point go, hey, I just want to work with you directly?
Good question. That's a thing we hear a lot. The reality is that working with the bank directly means us, right? Because, we're really a partner to the bank. What is direct, right? Is it like directly to like the mainframe? I suppose, you could, but the banks that we work with, if you called them and you said, I want to work with you directly, they would say, cool, here's an API key for Treasury Prime. Basically, we're the access point that they can expose publicly. And remember, like a lot of their systems, these are mainframe systems. These were built before the internet happened. They are not built in such a way that you can safely expose them to the internet, right? They're built to be exposed to bank employees and really bank employees only. Frankly, that was part of the difficulty before Standard Treasury and Treasury Prime came along. Part of the difficulty as a fintech trying to work with a bank is they would have to be very reluctant and very careful, because if they gave a fintech access to their systems, effectively they were giving them root access to the bank. So you need a huge amount of trust. And that's still true of us. When we work with a bank, they need to have a huge amount of trust for us, because effectively, like, they're giving us root access. And then it's our job to make sure that we're access controlling this in a way that's safe for the internet and for all the different developers and all of that. This is just core to our business, right? Is we need to be extremely, extremely trustworthy. We always need to be like really good actors so that our banks, trust us to fill that really special role.
Banks make their money on lending, but most of these fintechs don't offer lending. And so they make their money on interchange. Like, how difficult are the unit economics in an interchange model? Or what are some business models do you think are most sustainable built on top of your API?
Well, I would say not every fintech is orienting their revenue around interchange. Definitely some are. And certainly, like, we've seen some in the press. I think, Chime has sort of said, that interchange is a huge component for them. But that's not true of every fintech. And certainly there are lots of like embedded finance cases where the business is really using the banking features as a way to enhance their other products, right? It's sort of a value add less than a primary revenue driver, even though it may generate revenue. So it's really all over the map, right? Some are focused on interchange, others are focused on maybe having more of a monthly fee, SaaS-based structure. We see it all. For the most part, our banks who work with us, usually what they want are deposits. That's a very typical thing. When I think about, if I'm a smaller bank, right? If I'm not one of the like top 10 banks, what's my strategy for deposit gathering, right? I mean, for the past like 200 years, the strategy has been pick a town that doesn't have a bank, build a building in the center of the town. That's the bank. Everyone in town will bank with you. Congratulations, you've gathered deposits. But like that geographic monopoly, that's just not true anymore. In the 90s, we did a bunch of deregulation that like re-legalized interstate branching. And then we have this thing like the internet now, right? And like, we can all have a Chase Reserve card, even though none of us live in Manhattan. If I'm a smaller bank and I don't have $1 trillion on my balance sheet and I don't have 10,000 engineers building custom software, what am I supposed to do? How am I going to gather deposits? I don't necessarily have a lot of good options. What's cool is the fintech market and the sort of embedded finance market and a lot of these new, more online oriented opportunities for the banks who are able to kind of wrap their head around that. They can work with us and they can access these markets that otherwise they wouldn't be able to access. And so that can be really powerful if you're a small bank.
Amazing. And there's also like a regulatory angle here, right? Where like if you're a bank with less than a certain amount of deposits, you can charge more on interchange or something like that.
You're right. That's right. You're thinking of the Durbin Amendment. This is a part of the Dodd-Frank legislation back in like 2010. Basically, if you are a bank smaller than a certain asset size, you're what's considered Durbin exempt, and your debit card interchange is not regulated. So for banks above that size, it's basically capped. They can charge, only a low specified rate on debit card interchange, but below the banks that are smaller than that, they're not subject to that cap. And so for a Durbin exempt bank, debit card interchange can be, 100 to 150 basis points, depending on like the particulars. And it's substantially lower for bigger banks. So that's sort of a structural regulatory advantage right now for the smaller banks.
So if I build on top of your API and let's say I want to switch banks, like is a simpler process than it would otherwise be? Do you see that often, or is that something that's pretty unusual?
That's one of the key benefits for us too of having this network of banks. We, no matter what software the banks are actually running at sort of like on the metal, we've built an API that's generic enough and general enough that you can build to our interface and it will run effectively at any bank that we work with. And so, yeah, that really de-risks you as far as what happens if you need to move banks, want to move banks, or maybe add a second bank, right? As you scale up, hopefully, your business is working great. You're collecting a ton of deposits. Maybe you're getting big enough. You want to add a second bank. We can do all of that in a way that you don't really have to make code changes. We have a partnership model that's really working and is really oriented around long-term success. And so it's rare that anyone has to move, but it has happened. And actually we have moved customers between banks before, and it's very doable. It can be done, in a matter of weeks, and they don't have to make large code changes. And so it's pretty seamless. And that really de-risks something that, prior to something like Treasury Prime, That was a real concern for fintechs. If your relationship with your bank doesn't work out and you have to move, it's a huge, huge lift. But we've made that so it's really not that big a deal. And that's super cool.
So Jim, you've seen fintech from the beginning. You've seen a lot of the changes happening. You're running an API company enabling all these new use cases. We see companies like Lithic making it super easy to spin up card numbers. So I'm curious to hear, what are the use cases that you're most excited about in the next, let's say, 5 to 10 years? And what do you think we'll be surprised by?
So I'm a believer in the sort of like fintech market broadly, sort of like macro approximation here. I would say run this thought experiment, like sum up all the deposits in total at every fintech in the US. What's the number? It's more than $1 billion, but like, is it 10? Is it 20? I mean, like there's some number in there, but it's not a trillion. Meanwhile, the total amount of deposits in the US is like 20 trillion. And so to me, fintech is like at the very beginning. There's a ton of headroom. To me, like when I think about this, the only way it could possibly reverse is if all of a sudden everybody changes their mind and wants to go back to banking at traditional banks with their sort of legacy product stack. I mean, I don't know. You can do your own math on whether you think that's more or less likely. But I think fintech broadly has a ton of headroom. And so then I think, well, if we're going to scale that up, how's that going to go? I think we're going to see a continuation of the trends we've seen over the past few years, which is like we see people launching neobanks for very targeted audiences and often integrating them with other products and services that are targeted to those same audiences. One example is, let's say I want to start a neobank for landlords, somebody who like owns buildings. Well, I can do that. I can provide them banking services that are tailored to them. I can provide them business software to help them manage their properties, right? And I can do all of that in sort of a way that it really fits nicely hand in hand. And I'm helping them run their business. I have the financial banking component built in, and that's like a really tailored experience. It's designed for a particular customer, a particular market. That makes a ton of sense to me. And I think like we see a ton of companies who are approaching markets like that, where they're saying for this particular customer, instead of handing them just some generic checking account and saying good luck, how can we really make that experience great? I think we're just going to see a ton of that across like every possible vertical.
That's fascinating. I love the framing around the existing dollars in fintech and the total market of dollars that can be in fintech. That does indicate that we're at the beginning. That's exciting to think about. There's a bull market with crypto right now. There's been multiple waves. There's a lot of exciting stuff happening with NFTs and DeFi. Curious to hear your take on that. Do you see that eating share maybe for certain use cases, or are you more skeptical of it? Curious to hear your thoughts.
Yeah, I mean, I think that there's clearly a ton of excitement in that space right now, a ton of money flowing in. For my part, I'm a very like practical product-minded person. So the question I always ask myself in a lot of these crypto use cases is, what's the product experience that's really making better? I think that some use cases have that, some don't. And it seems like pretty early days to me. I'm not sure how it'll all shake out, to be honest with you. We certainly have like a Treasury Prime. We have a variety of customers who are doing crypto work. They're working with banks in our network who are excited about crypto. So like we definitely serve that market. I think there are a lot of good products there, but it's just, there's so much going on. It's sort of like hard to generalize about it,
Yeah, that makes sense. If there were a winning use case, do you have thoughts on where that might be?
This is like probably a pretty boring answer, but I think international settlement is a pretty natural crypto use case. I can definitely see the utility there. I think anyone who's had to send an international wire like through an intermediary bank and like has tried to debug that, they know that feels like a pretty archaic process today. And that's the sort of thing that the utility is like immediately there, even with a pretty basic crypto setup. So, I mean, that's a pretty boring answer, I think, but that's one that's easy for me to see.
More generally, just programmatic settlement, like Sidecar settling, having to like pay out like, hundreds of thousands of vendors, and people spend like enormous amounts of time on this sort of stuff, from what I can tell.
Well, and there's a ton of very valuable businesses that provide services to try and make that easy, right? I mean, from like Bill.com or like, others. I mean, that it's just, there are a ton of payments businesses that are trying to make business payments easier. So yeah, I mean, for sure. I never want to underestimate how much, at least Americans, like their credit cards, right? Got to get those airline miles. I think a lot of these businesses, especially these crypto use cases for business payments, they neglect some of the things about credit cards that from one angle might seem like bugs, but on another angle are features, right? It's like, hey, that high interchange rate for merchants, that's a bug, but for, purchasers, that's a feature because you get that great benefits level, right? Same goes for like reversibility. Merchants are like, hey, I hate chargebacks, but when you're buying something, if having that level of
Yeah, it's awesome.
feeling of safety and security, being able to charge something back, that goes a long way. So it's tough to figure out solutions to these things. And we'll just have to kind of see where the market takes us.
There's a lot of interesting use cases that are sort of blending CeFi and DeFi, like centralized and decentralized finance in interesting ways. And I think you guys could really like play a role in that. Like I just signed up for a BlockFi credit card where I get Bitcoin rewards. It's awesome. So I'm excited to see more products in the space.
So Jim, we have a few questions that we ask every guest. And the first is around superpowers. So everyone has some skill or set of skills, either things they have naturally or skills that they've worked on through deliberate practice that they're eerily good at. And it feels like play to them and it's work to other people. I'm curious to hear, what are some of the skills that you've learned to leverage over the course of your career to be more effective?
Yeah, good question. I don't think I have any superpowers. I mean, I think that if we seem to have a superpower as a company in the space that we're in, it's really because it's what we've been talking about, right? It's like being part of Standard Treasury and really just beating our heads against this wall for like 8 years. It means we've sort of seen a lot and had a lot of time to sit and think about all the ways we're failing and try and build an incentive structure, build a company, build a product that really fits the market. It's really cool to me that fintech is really coming around now because it feels like we've been pushing that boulder up the hill for a long time, and finally we're in a place where the market's ready and it's rolling on its own now, and so that's cool to see.
That's a great one. The other question is around people who have given you a break. Are there moments in your career where you feel like it could have gone either way and someone stepped in and helped you out in a way that was lastingly impactful?
Yeah, in a proximate sort of way. All the people that I work with today and have worked with through Standard Treasury, and say like my co-founder, Chris, or Dan Kimmerling, who was the CEO of Standard Treasury, now one of our board members and investors, Mike Clark, who is an engineer that I worked with at Standard Treasury, works with us now as our VP of engineering at Treasury Prime. We've all stuck together through this long project. And, I think that's been really, really great. Great to have that team and that continued expertise and all that support. And I think that's, this wouldn't work without them, right? It's tough, I think, in Silicon Valley, especially to work on something for this long when there's so many other shiny opportunities, right? At the very least, you can go work at Google and make how much money. I think the commitment to the mission and the product and all of that, it's been good. I don't think, we couldn't, none of us can do it alone, right?
And last question is around books. Are there any books that you've read recently that were very memorable?
I'm always partial to like David McCullough and like some of these like history biographies. I read his Truman biography a couple of years ago. That was really good. Obviously, he's done stuff like it was, around the Revolutionary War and all that. So, I'm a fan of like American history, and I don't know. I wish I had more time to read, but I have 2 little kids. So right now I've got that newer Abe Lincoln biography on my nightstand. It's pretty long, so probably be a little while before I'm done with it.
Totally understand. So Jim, Zane and I have learned a lot from this conversation and we were really excited about it. And